Hi guys. This video is the first in a series looking at monetary policy and banking and the whole financial system of the macroeconomy. We're going to learn in this topic how money works, the functions of central banks, the tools of monetary policy, the financial system and how it works, what its importance is, and how central banks and the Bank of England in particular manage the financial system. In this first video, we're going to be looking at the concept of money, how it's measured, what its functions are, as well as overviewing the role of central banks in an economy. Let's start by looking at the history of money. And to understand where modern money came from, we need to cast our minds back thousands of years to prehistoric societies. Imagine that I own a goat, but I'd really like an axe. In a prehistoric society before money, the only way to get an axe with my goat is to swap my goat for an axe. This is a process known as barter. Barter is trading just by swapping goods and services. Now the problem with barter is that it requires what we call a double coincidence of wants. What that means is that I need to find somebody who not only wants to get rid of a goat, get rid of an axe, but wants to gain a goat. I need to find somebody who has the opposite desires to me, and therefore is willing to make that trade. Now that's going to be quite difficult and quite time consuming. And so with a system of barter, we're likely to see much less trade happening than we would like. As a result, over time, money developed. And the first form of money was called commodity money. And this was money that had an inherent value. So for example, gold coins. Gold itself is valuable, and therefore coins made of gold are valuable by virtue of what they're made out of. Money has the advantage of forming a universal medium of exchange. Because it's accepted by everybody, it's wanted by everybody. So now, if I want to get rid of my goat, I don't need to find somebody who wants a goat and has an axe. Instead, I just need to find anybody who's willing to buy a goat for money, and then I can use that money to buy an axe. It solves the problem of double coincidence of wants. And what's really nice about that is that because it makes transactions so much easier, I can be more certain that what I make, I'll be able to trade. And that means that I can specialise. I could get really good at making goats, knowing that I can sell my goats to get everything else I need. And that's how modern society exists. In the modern world, nobody is self-sustaining. Everybody makes maybe one thing with their work, but they produce that service or that good in exchange for money, which they can use to buy everything else: food, housing, clothes. Money is fundamental, therefore, to economic development. Commodity money's been around for 5,000–6,000 years, but it has its drawbacks. The problem with commodity money is that it's money that has an inherent value, and so there's an inherent risk to casting it around. And that led to the development of representative money. So let's zoom forward to maybe the 15th, 16th century, and imagine that you're a wealthy merchant, you're traveling from town to town, you're carting money around with you. That's inconvenient, it's heavy, you're likely to get stolen. So instead, cunning entrepreneurs might set up a service whereby you deposit your money, your gold, in one bank branch, and in return you get a slip that you can exchange for the same amount of money in a different branch in a different city. And that means I can travel around without taking my actual gold with me. Instead, I just have this slip of paper, which is I can exchange for money. And that slip of paper became what we know as a modern banknote. We call it representative money because that note represents money, but because it represents money, it became acceptable payment. People started to be prepared to be paid in these banknotes because the banknote was as good as money, because it could be instantly exchanged for money. This convertibility of banknotes to gold actually hung around for quite a long time. The formal backing of banknotes was known as the gold standard, and it stuck around in the UK for quite a long time until 1931, and in fact it made a brief reappearance. And there's a remnant of it still, even on the latest £5 and £10 notes. They still say, "I promise to pay the bearer on demand the sum of £5," reflecting the fact that historically banknotes were always about being able to convert it into money rather than being money themselves. That's no longer the case, however. If you were to go into a bank and ask for £5 of money, you get laughed at and politely asked to leave. And that's because the money we now have is called token money or fiat money. Token money is money with no intrinsic value of its own. And so we're mainly thinking notes and coins issued by the Bank of England. They're also known as fiat money, which refers specifically to notes and coins backed by the government. Another term for being backed by the government or the central bank is legal tender. Only notes and coins issued by the Bank of England are legal tender in the United Kingdom. Cash no longer has an intrinsic value. I can't exchange it for anything for gold, but it has value because it's backed by the Bank of England and because everybody perceives it to have value. And that's modern money, token money, money which doesn't have intrinsic value but which is accepted universally. Not only does it include cash, notes and coins, it also includes bank deposits, money that's digitally saved in bank accounts that I can access. And there's different definitions of money that vary by how much of these bank deposits we include. We'll come on to that in a moment. So guys, that's the history of money. That's where money came from. It's really useful to have that framework because it helps us understand why money is as it is these days and what it does. But we need to think briefly about the functions of money and then the characteristics of good money before we come on to measuring the money supply. Money has 4 key functions that we need to know about. Firstly, money forms a medium of exchange. Money is used to exchange goods and services, and as we've seen, it's more efficient than barter. It forms an intermediary in transactions and avoids the double coincidence of wants problem. Secondly, money is a store of wealth. It is an asset. That's a term we'll be using a lot in this topic. Money is a useful store of my wealth. It's not the best store of wealth in some ways, but it's the most easy to access. It has generally had low returns compared to other stores of wealth and other potential investments, but it's very easy to use, and we'll think about that in a moment. Those first 2 functions are the most important. Those are the ones that the AQA exam board is most concerned about. But money has a couple of other traditional functions. Thirdly, money is used as a measure of value. It enables comparisons between items. It's an objective measure of value, and I can use it to infer information about different goods and services, which is likely to be better. We also talk about money as the standard of deferred payment. Because money has a consistent value over time, money enables borrowing to happen. In a world with no money, it's very hard to imagine credit, borrowing happening. But when we have money, we can trust that the value is going to be sufficiently consistent over time that we can use it to borrow. And that's fundamental, as we'll see in this topic, to enabling economic growth, development, and recovery from a recession. These 2 last functions, the measure of value and standard deferred payment, together are known as the unit of account function. And essentially, they enable the price mechanism to work. Go back to microeconomics, topic 2 and 3, if you want to see more of that price mechanism. So money has a number of different functions. I think they're fairly straightforward. Let's think about the characteristics of money. What makes good money? For an item to be effective money, 6 things it needs to be. Firstly, it needs to be acceptable. We need it to be accepted universally in a country. Otherwise, it's useless. If I decided that my balled pens were money, well, that's useless. Nobody accepts them as money. If I printed my own currency, it's useless. It needs to be durable. It has to physically last a long time. And newer banknotes have put more thought into this. Newer banknote designs are more durable. Money obviously needs to be portable. It needs to be easy to lug around. It needs to be divisible, so we have to be able to divide it into smaller units like pounds and pennies. It has to be scarce. If anybody can just create money, it's not scarce, and it's therefore useless. We can't control its value. So if I were to use, say, tree leaves as money, or sand as money, it's not scarce. And so I've got no ability to, it doesn't hold its value, because people can just get more. And similarly, it needs to be difficult to forge. If people can just copy money, it's not scarce. They can just produce it very easily. These 6 functions would make for effective cash, and by cash we mean notes and coins. Most money these days is digital, but it's much easier to replicate these different functions in a digital world. Just as an aside, this is my favourite example of what isn't good money. This is a rye stone. They're used in the Polynesian island of Yap. This is over 2 meters in height and is used to stand for the money, the wealth of a household. It's largely ceremonial and dollars are mainly used. It's bad money. is in at least as in terms of our criteria for effectiveness. It's not durable. It's not divisible. Well, it's very durable, but it's not divisible. It's not portable. We need to achieve these 6 functions to have good money. Electronic money. You'll hear more and more talk about cashless societies, but this applies more generally to just digital money. Exact same ideas, but we're replicating it by software. We need to make sure that digital money is durable. It can't easily just be deleted or forgotten. And software needs to make sure that it is scarce, that it can't just be created digitally. All of these things need to apply to the money in your bank account just as much as they do to the pound notes in your pocket. Okay, here's a quick thing for you to think about to make sure you've got the logic. There's 5 examples on the screen of really bad things, if they're going to function as money at least. Take a quick minute just to skim through and see if you can apply a different characteristic to each one. Why would each of these make the following? Why would each of these be poor as money? And see if you can pick a different characteristic for each one to explain. It's fairly ludicrous, isn't it? But hopefully it's fairly obvious. Sand is not scarce. Cows, well, they're not durable. They're not portable, and they're probably not very divisible. Cars are portable, but they're definitely not divisible, and they're not very portable. Ice is certainly not durable, is it? It melts. And paintings, I guess we could say a few things about paintings, but they're certainly not universally acceptable. Okay, 2 more things to go. Let's talk about how we measure money. It sounds kind of obvious, but actually it's been a topic of a fair amount of economic debate in the past 40 years. See, we need a bit of context here, and we're going to come back to this more when we look at monetary policy. But remember the Keynesians? Keynesian economists argue that the money supply is not very important. They argue that inflation is pretty insignificant. So long as the economy is stable, we're not really worried about what the inflation and the monetary supply are doing, because they're not real variables. Keynesians are interested in growth and unemployment. The money supply is not a hugely important factor. The problem was Keynesian economics largely broke down in the 1960s and 70s, as we saw, because it didn't have an answer for the problem of inflation and inflation expectations. And into the void stepped monetarist economics. And monetarist economics largely focused on inflation. And if you remember from our inflation topic, we saw that within monetarism, the argument goes that the key driver of inflation in the long run is the money supply. And inflation is crucial because it affects confidence and expectations. We can end up being stuck in stagflation, as we were in the 1960s in the UK. So when monetarist economists came to the fore in the early 1980s or late 1970s, measuring the money supply became much more important than it had been before, because we need to control the money supply. And we can't control it if we don't know how much money there is. The problem is something called liquidity. And liquidity, if you haven't come across it before, is a crucial word in economics. It refers to the ease with which an asset can be converted to cash. And an asset, incidentally, is anything which has value. Ease means a few things. Obviously, the most liquid asset is cash. I can spend it instantly. But other things are more difficult to spend. Take physical assets, buildings, houses, cars. It's difficult to spend them, because to turn them into cash, I've got to go through the process of selling them. So when we talk about ease, we both mean how long it takes to convert something to cash, but also how difficult it is. Have a play around with this idea by trying to put the following in order. Here are 4 different things: cash, houses, stocks and shares, and fixed term savings accounts. So that's savings accounts where I can't get my money out for a certain period of time. See if you can work out which is the least and most liquid. I guess there's a bit of debate here, but here's what I got. The most liquid is obviously cash, because an asset, how easily an asset can be converted to cash. Well, cash is cash. It's the most liquid asset. Stocks and shares, I put second, and that's because stocks and shares I can sell very, very quickly on the stock market. Fixed term savings accounts and houses are obviously the least liquid, and you can argue either way round. I put houses at the bottom, not because they take a very long time to sell. I might be able to sell it more quickly than I can access my fixed term savings account. But the problem with a house is that it's difficult to sell. It's inconvenient. Liquidating physical assets tends to be regarded as the most difficult thing to do. With a fixed term savings account, it's not difficult, I just have to wait. But the problem with liquidity is I've got to work out what I count as cash. Obviously, I'm going to count notes and coins as part of my money supply. But do I count bank accounts? And if so, which bank accounts? And because of that, there's actually more than one measure of the money supply. There's about 7 or 8, depending on what you look at. But we're going to just look at 2, and we only need to know the rough detail. We'll see a little bit more detail when we've looked at more of these financial assets in a couple of topic videos' time. The first definition of the money supply is narrow money. This is notes and coins, as well as liquid bank accounts. And we mean very liquid bank accounts, instant access. Normally, narrow money only includes the reserves held by commercial banks at the Bank of England. But again, more on that in a little bit. So it's money that can be instantly accessed. Broad money is the other measure we need to be concerned about, and that is all of narrow money plus some assets that aren't liquid. And usually the threshold we use for liquid is about 5 years. So investment accounts with a maturity of less than 5 years, and again, more in a little bit. But that's a broader definition of money. And we're interested in broad money because although those things can't be spent instantly, they do reflect, to an extent, the spending power of the economy. And so we are interested in both broad and narrow money. And often both measures will be reported. If you look up money supply, you'll see a range of different websites using a range of different measures. These are the 2 most common. We don't need to know the detail. There are other measures, M1, M2, M3, M3H, M5, M6, and others. We don't need to know them. And we don't need to know the detail of these measures particularly. We just need to be aware that there are a couple of different measures, not least for when context questions require us to deal with these things. You'll see here on this graph that broad money is quite a lot broader in the UK. This measures the UK money supply from 1982 until 2020, and it measures it in millions of pounds. So you can see that there's an awful lot of money in the economy if we look at the broad measure. Narrow money hasn't changed a great deal. Before we look at central banks, let me just explain how this might come up in the exam. We're most likely to see the content we've looked at today in 15-mark questions with AQA. We wouldn't see it in 9-mark questions because 9-mark questions require a diagram, and there aren't really any diagrams we can draw to accompany these. But 15-mark questions listing and getting us to explain functions and characteristics are quite common. And so these would be quite nice questions to do. The wrinkle is that there's more than 2 points, we might say. Normally with a 15 marker, we'll be thinking about writing 2 chunky points. And so we'll need to think about how we group our different functions and characteristics together to make 2 well-explained points. Lastly, guys, let's have a quick overview of central banks. And that's going to finish building our foundation that we need to dive into more monetary policy and financial markets detail shortly. See, central banks are the institution that governs the monetary system. They're in control. This is the Bank of England and Threadneedle Street. It's the oldest central bank in the world. And it exists, like every central bank, to regulate the economy's monetary system. Central banks have a number of crucial functions. They're aiming to achieve financial stability. Central banks are there to ensure that the financial system works, to ensure that it's liquid enough. And that means there's enough liquid assets in the system that if there's a crisis, it doesn't collapse. Central banks are often responsible for monitoring the financial system and also regulating it. And we'll see more of that in the final chunk of this topic, financial market regulation. The Financial Policy Committee is the group who organises this in the Bank of England. There's another couple of groups that will meet in the financial market regulation subtopic. Secondly, the Bank of England is responsible for macroeconomic stability. And as we've seen before, the main aim is price stability, that 2% inflation target. But subject to that, they're interested in supporting the government's economic aims of achieving high growth and low unemployment. In their words, they aim to deliver price stability, that is low inflation, and subject to that, to support the government's economic objectives, including those for growth and employment. The key thing to note here, guys, is that price stability is the most important aim of the Bank of England. And it's the Monetary Policy Committee that makes the decisions to achieve that aim. Lastly, central banks have a number of different tools to achieve these. We've seen this detail in the Monetary Policy Committee before. There are a couple of minor aims before we move on. I apologise. Thirdly, the Bank of England regulates the issue of currency printed by the National Mint. And fourthly, it acts as a banker's bank, and this is going to be really crucial going forwards. Commercial banks keep their reserves at the Bank of England. So HSBC, RBS, NatWest, Lloyds, all these high street banks and other banks keep their reserves of cash at the Bank of England. And that's going to be a really crucial feature of monetary policy. In extreme circumstances, they can borrow from the Bank of England, but normally if they need cash short term, they'll borrow from each other. The Bank of England also acts as the government's bank. The Bank of England used to be responsible for dealing with raising funds for government spending, but that's now dealt with separately. But the Bank of England can lend to the Treasury, to the government, in exceptional times. Normally there's a small overdraft function, but in times of crisis, the Bank of England can lend quite substantially to the Treasury. And lastly, the Bank of England is responsible for overviewing the exchange rate. And I say overview here because the UK has a floating exchange rate system. So the Bank of England doesn't directly intervene to manage the exchange rate, but it is responsible for monitoring the exchange rate. Okay, let me quickly run through the tools, the different things the Bank of England can do to achieve these aims. The big one is interest rate management. The Bank of England sets the base rate of interest. It also manages the money supply, but normally it uses something called quantitative easing to do this, which we'll look at in a couple of videos' time. Thirdly, it regulates financial markets, sets rules to manage how financial markets fit together. The less conventional instruments we're going to look at, one is quantitative easing, though most people would now say that this is not an unconventional instrument anymore. This is now a normal part of central bank policy in developed countries. And we're secondly going to look at two tools called funding for lending and forward guidance that the AQA requires us to have a knowledge of. These are both quite outdated, but we're going to have a look at them anyway. Guys, that is our overview done. We've looked at central banks, we've looked at money, where it came from, what its characteristics are, and how we measure the money supply. And the knowledge you've picked up in this video, you need to have a clear understanding of in order to dive into the rest of monetary policy. So do go back and have a look at anything you didn't understand, if there's anything you need to review before watching the next video.